Welcome back. We are now doing Module 2 and Chapter 2. I hope by now that you have done the Introduction to Debits and Credits video and have a fairly good idea of how we're doing that. We'll stress that later in this video on how we do debits and credits more. But remember, debits and credits are like multiplication tables. If you do them repeatedly, I call those the reps or the repetitions. You need to do that so they become second nature for you. And the time that you spend locking in these fundamentals are going to be so important for you as we go on with our chapters. So, with no further ado, we'll get hot doing that now. All right, what do we do with financial accounting? We're trying to measure business activities by recording transactions, like our debits and credits, and communicating that eventually when we prepare our financial statements. All right, how do we do that, measuring business activities? Well, here's the basic steps in measuring external transactions. They have 6 of them here. First, we're going to gather our source documents, our backup for which identify the accounts we're going to use. Then we're going to assess how that affects the accounting equation. Then we'll determine what the debits and credits are going to do, and we'll record that in a journal entry using those debits and credits. We'll post those journals to the general ledger, and eventually then at the end of the period prepare a trial balance. Now, I use a little more simplistic version of that, which I will tell you now. First of all, we're going to determine what accounts we're going to be using. Second, we're going to say, where do those accounts live? Do they live on the left or do they live on the right? Then we're going to say, what is happening to those accounts? Are they going to go up or are they going to go down? The first part of this video, we're going to determine the accounts going up or down. And then once we've done that, we're in a position to do the debit and credit. All right. Here we're talking about assets. So we have some examples here. Our 4 major current assets are cash, accounts receivable, inventory, and here supplies are treated as our inventory. Okay? And equipment is a long-lived asset. It's going to be called a fixed asset or a long-term asset or a plant asset, because we don't expect to sell that equipment for more than a year. If we expect to sell our supplies and our receivables and all that within a year, that's a current asset. Liability accounts, we have our big one, which is accounts payable, but we also have some other payable accounts. All of those are liability accounts. If we expect to pay them within a year, then they're a current liability. If we expect to pay them in more than 1 year, then they're a long-term liability. And lastly, we have the stockholders' equity accounts. We basically have 2 components of that, common stock and retained earnings. And we'll talk far more about that as we go along in the course. A chart of accounts, a key piece of terminology here, is just a simple listing of all the account names that we use to record transactions. So if you wanted to know where you would record a certain transaction, then you would look it up in the chart of accounts and you would say, okay, utilities, and you would put it there. Or it might be electrical expense, and you put it there, depending on what your chart of accounts said. All right, but the key thing here is the accounting equation. Our accounting equation consists of assets, which equal our liabilities, plus stockholders' equity. Assets equal liabilities and stockholders' equity is the accounting equation. Assets are our resources. Liabilities represent outsiders' claims to those resources, while stockholders' equity represents our owners' claims to those resources. So, to balance the accounting equation, if assets go up, then liabilities and stockholders' equity need to go up. If they decrease, just the opposite. The accounting equation must always stay in balance. So, we're going to determine here 3 questions. How is one account affected by that transaction? And what is the second account affected by that transaction? We must have at least 2 accounts, one a debit, one a credit, for every transaction. Sometimes we might have more than one debit or more than one credit, but the journal entry must always balance every time. Okay. Here's our old friend Eagle Soccer Academy with a bunch of transactions which we'll practice with. First step in this is to determine how these transactions affect these accounts. Are they going up? Are they going down? And how is the accounting equation affected by that? All right, we sell shares of common stock for $25,000 to obtain some funds to start the business. Okay, what is the first account? And that is going to be cash. We're getting cash from our investors. Okay, so cash is going to go up. And that cash lives on the left-hand side as a current asset. And on the right-hand side, common stock is going to go up. Common stock lives in the stockholders' equity section on the right-hand side, and it's going to go up too. And it looks like this. As you can see, the accounting equation stays in balance. It's sometimes tempting to decrease cash because you're thinking of it from the perspective of investor, because his cash is going, or her cash is going down. But from the company's perspective, the cash is going up. And remember the entity principle, so we're going to make sure that we record that as an increase in cash. In transaction 2, we're going to borrow some money from the bank. In this case, we're going to sign a formal note. If we sign a formal note, it's going to be a note payable. If it's simply a promise to pay, it'll be an account payable. But here it's a note payable. Cash is going up because we're receiving money from the bank, and notes payable, a liability, is going up on the right-hand side. As you can see, again, the accounting equation remains in balance. Now we're going to purchase some equipment. Both of those are assets. Equipment is a long-term asset. Cash is a current asset. But both of them live on the left-hand side. Cash is going down to pay for the equipment, and equipment is going up. All right. What would be the effect on total assets if a company purchased land for $200,000 in cash? And if you answer Charlie, land is going to go up, cash is going to go down. Both of them are assets, so the effect on total assets would be 0. Key point. After each transaction, the accounting equation always must balance. I said that earlier. Okay? In other words, the assets must always equal liabilities plus stockholders' equity. And get in the habit of thinking about that until this becomes so second nature you don't need to. Okay, transaction 4. Pay for rent in advance. This is called a prepaid asset. Prepaid rent in this case. So, prepaid rent, generally a current asset, and in this case it is. Cash is going to go down to pay for that. Prepaid rent, another asset, is going to go up. So essentially no effect on the accounting equation. It still remains at $35,000. And now we're going to purchase some supplies, and we're using the terminology on account or on credit, it would often be referred to. And in this case, this is a promise to pay, not a formal written note. So we are purchasing some supplies on account for $2,300. Supplies, the asset supplies, is going up by $2,300, while the accounts payable is going up as well on the right-hand side. That does increase the accounting equation to $37,300. All right, the expanded accounting equation. Here you can see there's the basic accounting equations: assets equal liabilities and stockholders' equity. But we're breaking stockholders' equity down into two components here: common stock and retained earnings. And then we break retained earnings down into these three categories. And those are revenues, expenses, and dividends. We will find out later that revenues and expenses are on the income statement, and we subtract expenses from revenues to get to net income. But dividends is not on the income statement. It lives only on the retained earnings statement. And lastly, I will say this: we zero out the income statement at the end of the period. We call those the closing entries, which we'll talk about later in this course. But here we're going to populate revenues and expenses, and when we zero them out at the end of the period, that's when they go into retained earnings. Okay? And we call that the expanded accounting equation. So the key point here is that revenues are going to increase retained earnings. Expenses will decrease retained earnings. And that's eventually, at the end of the period, that will occur when we zero out the income statement. Dividends decrease retained earnings. So retained earnings then is a component of stockholders' equity, just like stock is. All right, now we're going to provide some soccer training to our customers. Here we're talking about revenue for the first time. And we're going to increase our revenue, which will increase our stockholders' equity. And we're going to get cash, which will increase our cash. So now the accounting equation remains in balance and goes up by $4,300. This seems like a good place to stop for right now. And when we return in video 2, we'll start with transaction 7.